All right, ladies and gentlemen, boys and girls, friends and colleagues, and maybe people that don't even like us. Good morning, good afternoon, and good evening. Welcome down the Security Rabbit Hole to yet another edition of the Down to Security Rabbit Hole podcast. I'm Raph. Over my left shoulder, there we go, over there, that's James. Down there is Shawn Scranton, and over that way, that way, that's Mr. Tuma. I don't know. This is fun. I like playing squares like this. It gives me something to do in the intro.
It amazes me how difficult it is, Raph, for you to figure out where the squares are. Like that's the
I'm trying to orient myself because the camera is flipped, and when the camera is flipped, you're like, my right hand. No, wait, my left hand, my right shoulder. What's going on? Anyway. All right. For those of you not watching on the video stream, this is one of those you're gonna want to check us out on the video stream. But all right, I don't want to waste any time on this intro because this is the semi-regular I love this episode edition. And we've got the two Shawns. We've got, of course, our favorite legal Mr. Tuma. Hello.
Howdy from the great state of Texas.
Howdy. Have you all just melted into oblivion over there? Is that what's happening?
Man, it's been pretty brutal. I actually like the heat. I enjoy getting out in it some. Okay. And today is our last day in the hundreds. It's supposed to be 108 today. And my wife thought I was nuts when I said I wanted to get outside and do something. And so that means we're not. We're not getting outside and doing anything. So
you're a bit of a wacko. That's entirely too hot. 108. Good Lord.
It's like having a sauna, right? You go in, you just for like 20 minutes, Shawn, and then you're back inside, like just a quick hit.
Yeah. The thing is, right now there's not a lot of humidity, so it's more like the out west heat.
Oh, so it's a dry heat then.
Yeah, and so it's a little bit misleading. It's not like we're
it's not like here, Shawn, where you step outside and just insta sweat. Yeah.
It's still just an oven.
It's still hot. Yeah.
All right. The other guest on the show, the other Shawn, Mr. Shawn Scranton. How are you? You're from the I can't say the great state of Illinois because I've lived there. The barely hanging on state of Illinois. And James just dropped off because that's what happens when James leaves. He'll come right back, I hope. Anyway, all right. So on this one, and there he is. And now, James, you've completely messed up my where everybody's sitting. So thanks.
Yeah, I don't know what happened.
Watch this. Ready? Boom, boom, and I put everybody back.
None of us can see what you just did, Raph. It was.
I know that's unfortunate. That's too bad. Try not to jump off on us this time. All right?
Yeah, I don't know. I was just sitting here.
Anyway, all right. So we have our semi-regular episode where we talk law, we talk breaches, we talk what they cost people, and because pre camera rolling, this one struck me a little close to the heart here, as I am a huge fan of the White Castle burgers. Yes, those White Castle burgers, otherwise known as the sliders. Shawn Scranton reminded us, or actually alerted me, because I did not know this, of a interesting case. You guys want to break this down for us? Who wants to start?
Yeah. So, Shawn, you want to tell us? Well, no, I'll jump in and say.
Okay.
So it's the White Castle burger chain that Raph loves so much.
I love me some sliders. I'm not going to lie; they're fantastic.
The Illinois Supreme Court found or upheld a claim against White Castle under the Biometric Privacy Act, BIPA, there in Illinois, where it found that each time someone clicked in, using biometrics, each time they got scanned or however, the company's using that data without getting their consent was a separate violation under that law. And that law provides for $1,000 per occurrence in or per violation in damages, statutory,
Oy.
and 5,000 for intentional. And so, you just start doing the math there, and you see that under this BIPA law, even a small company that's violating these rules, by not getting appropriate consent before using biometric identifiers, is just facing catastrophic damages. And the problem defendants face under the biometrics law that we don't see under most of the data breach laws is these are statutory damages. And so you don't have to show causation, you don't have to show harm, all of those areas.
Oh, that's even somehow worse.
That's right. So all those defenses to class action litigation aren't there. It's almost like strict liability in a sense that it happens, you pay. And so, something's going to have to be done about this. But the problem from Scranton's standpoint is, people want insurance coverage for this, and insurance companies, they love losing money, right, Shawn?
They do. Whenever you say the words strict liability and private right to action and Cook County, Illinois, underwriters are going to be all over that. And they are. If you are looking to renew your insurance or getting insurance for the first time, I can almost guarantee you that they will ask you about biometric information and how, if you collect it, they will be all over you. How do you collect it? How do you notify? How do you, even for your own employees? So,
Man, that's painful. But you know what? That's fair, right? Because every single time, it's like speeding. If you pass 10 different speed cameras doing 125, you're not just speeding once, you're getting 10 tickets. So that's fair. You were an idiot 10 times. Good Lord. I'm at a loss for words on this because that's painful. And that seems kind of obvious though. Tuma?
Well, yeah, look, the Supreme Court got all the heat here, but the Supreme Court's interpreting the statute that the legislature passed, and the legislature is elected by the people. And so ultimately, that's where the remedy lies in correcting this kind of thing. Is you got to go back to the legislature and say, come on, is this really what we're intending here?
Yeah.
That requires an informed and knowledgeable populace, right? And so we'll just stop there.
That is interesting. Speaking of informed, I'm going to pitch another one over to you, Tuma, because it was the SEC, I believe, that released some very interesting, like they're getting into the game of holding people accountable. I got asked to do for a quote on this, and I've dug into it only as far as I think my brain has allowed me to, which is to say about ankle deep into this muck. But if I didn't know some of the things I know about the SEC from some mutual friends that have written books because they've had some bad episodes with those guys, I'd say, well, that's a pretty good place to hold people accountable. Federal Trade Commission, Security Exchange Commission, like those are interesting places, good regulatory bodies to hold companies and folks accountable. But this one was very interesting because it said, investors have a right to know if you've had a material breach, and if the breach you've had is material to your organizations. Now, I think the term is material impact because I'm not a lawyer, but I've read some of this stuff. And so everybody wants to know, like, okay, what does that mean? What does that mean to you guys?
Yeah, so that really is a very interesting issue for a lot of reasons. Number one, the SEC first previewed that they would be getting into this formally about a year and a half ago. So it was the spring of 22 when we first started getting this proposed rule out from the SEC.
Yeah.
That's the one where they said they were going to require cybersecurity expertise on the board.
That's right.
That had strong opinions either way. That didn't make it into the final rule, by the way. But they do expect updates on cybersecurity oversight and how they're overseeing it from a director standpoint. So it didn't get in there formally, but it did make it in terms of they're expecting directors to have oversight, and they want updates for investors on how the directors are overseeing this. But the part that's caused the most consternation here is that they've said, within or a publicly traded company has to make a Form 8K disclosure to shareholders of material cybersecurity incidents within 4 business days of the determination of materiality. Okay. So that materiality determination is when the clock starts to run for 4 days.
Shawn, what do you know 4 days from bang?
Well,
not a whole damn lot.
That's why this materiality determination is so important, right? Because the truth is, in any incident, we don't know anything usually within 4 days,
right?
Unless the threat actor immediately comes out. And sometimes we haven't even contacted the threat actor within 4 days of discovery, right? Yeah. Because we're still trying to see, do we have viable backups? Do we know what information was potentially available to trigger maybe a public breach notification? And sometimes we look and say, we've got good backups, we can be restored in a day or two. We know that this system had no data available. We can look at logging, whatever, and there was nothing there. So we're not even going to contact the threat actor. And then 4 days later, they send an image with a file tree showing all your personal employee data. And you're like, oh, crap. Okay, now we got to go down this road with them, right? So 4 days after the incident occurs, we oftentimes don't know anything. Yeah. And so part of what we have to go through from a breach standpoint is determining, was there a compromise of personal data, right? A lot of times we don't know that for weeks, sometimes longer. The same analysis applies here, that we're still evaluating the status of backups sometimes, because if a company's B2B company and we know the employee data wasn't impacted, then it's quite possible that it's nothing but business data that's impacted, that's not going to trigger an obligation under the breach laws to notify. And so materiality can mean a lot of things. But what's really important to note here is materiality means, how is the investing public going to view it?
Right.
Is it something that a reasonable shareholder would consider important in making an investment decision? That's how this law or this regulation defines it, right? So it's very fuzzy, because everybody's going to have their own interpretation, but it has to be, a reasonable shareholder standard, not a subjective. And it means a lot more than a data breach, because it could mean an impact to operations that's going to shut down your ability to collect money. It's going to impact your profitability. That would not be something that would have to be disclosed under a breach notification law, but could impact the finances of the company or its long-term viability, and therefore would be material under this law, when it wouldn't be material or trigger the 50 states notification laws. So it requires a separate analysis also. In other words, you need to know in advance who you're going to be calling and relying on to make these determinations before this happens. That means you need your carrier team, you need your legal team, you need your forensics team. All this a phone call away. So when something noteworthy happens, you know who to call to start having these discussions. And it also means sometimes what's a material event on the occurrence of the incident or what's not a material event may morph into one as you're going through that process.
So, I mean, to your point though, Shawn, like the time to which you have to notify for this is not the time of the incident.
That's right.
It is
Not
the time
usually.
of however long it took you to figure out if it's material.
Yeah, right. Now, it
Yeah.
could be an incident where all of your operations are literally shut down, which we oftentimes see in a ransomware attack. And you know whether, I mean, you know, you've got employees all across the globe. You're not keeping this quiet because everyone just had on their workstation, greetings, we are here to help. We have encrypted your network, you know. So you're not keeping this one quiet. You're going
Right.
public with it. That's material when it happens. You might as well get your notifications out as quickly as possible then.
Okay. All right, two questions. One, for Sean Scranton, I want to know, what is this like? How does the how does this thing get viewed? This piece of, it's not legislation, this piece of guidance, this piece of regulatory something. How does this thing get viewed by the insurance world? Because I imagine there could be some ramifications in there.
Sure. So my opinion, and I guess I should have started off. Anything I say is my opinion, and none of my employer. And I'll speak for Shawn. Shawn probably says the same thing as well. You know, in thinking about this, I would see it a couple things on the cyber insurance side. I would want to know that all of the things that Shawn talked about, that these were included in our incident response plans, that they were practiced, that the communications people, the media people, they were knowledgeable on these types of actions. You know, but more so towards the insurance side, I would see this probably more from a D&O perspective, directors and officers insurance, and because that's usually where you have your lawsuits, your shareholder lawsuits, those kind of things, and that's where cyber, and we call D&O, that's where cyber and D&O kind of get intrinsically linked. Whenever you have an issue, whether it's a material issue, whether it's financially material, or as you know, non-financial, as Shawn was talking about a data breach, that you could then have derivative lawsuits, you could have shareholder lawsuits, those kind of things. And so you want to make sure that your board is aware, which I'm sure they are if you're public, of these new requirements.
The issue of, you know, this fuzziness always worries me, right? Because what might feel, oh yeah, this is certainly material to one person, may be different to another, and knowing that there's an SEC Thor's hammer, should you get that wrong, is a problem. Who gets to make that decision, Tuma? Like, who gets to decide this is material, this isn't?
Well, it's a decision that has to be from an organizational standpoint. So your board has to have a role in that. I mean, they've got to be advised of that. It's more likely going to be a combination of your executive team, your in-house counsel team, your external counsel team, probably external forensics is going to have some input in this because they're going to be advising as to what is really going on and what they've seen. And then last but not least, for our listeners, you know, your CISO is going to be front and center on this determination. And oh, by the way, when it all falls apart, guess who's going to get blamed?
Yeah, that's
your CISO, right?
Yeah.
And that leads to another really important point about the SEC that we've seen over a few months ago is in the SolarWinds case, the SEC issued what's called a Wells notice or a Wells letter to the CISO from SolarWinds, which is a way of kind of forecasting, we may be looking at you personally for liability. Which is interesting because, we're on the heels of the Uber situation with the criminal liability. And this all really stems from like 2015, 2016 timeframe when the Department of Justice issued something called the Yates Memo that said, companies weren't going to start taking this stuff serious until we hold somebody personally liable and somebody goes to jail. We're seeing this whole thing here.
Look, I am all for holding adults accountable for their actions. That said, I've also worked in the enterprise for a minute, and I know that the person accountable isn't always the person that has any authority, or not any, but doesn't have the full authority, which to me means, boy, if you're going into a job, read that job description, particularly one that starts to smell like you could have accountability, right? Like that might be the time to talk to an attorney, a labor attorney, to make sure that you're not on the hook for somebody else's decisions. Because I can imagine, Tuma, that in like my worst case nightmare, you end up as a CISO of a company where the board and the CEO and the CFO make these decisions outside of you're not even invited to the dance. And then the SEC is like, oh, you know what? That was a breach. Guess what? CISO, Wells letter, we're calling you in a minute. You're like, well, wait a minute. I didn't do this.
And it's even worse than that. One of the private questions I get asked by CISOs on a more regular than it should be basis is, how do I protect myself? Because I've been raising alarms about this internally. I can't send anything external to prove I'm raising alarms about this, because then I violate my NDA.
That's right.
I violate company trade secrets. I violate all this other stuff. And what do I do to protect myself? I can't send this CYA email and BCC my Gmail, because now I've violated company policy for doing that. What do we do? And that's really a very, very challenging and difficult situation to be in, because they're raising the alarms sometimes. They're saying, this isn't right. We need to do something. It's falling on deaf ears. And then when it hits the fan in the end, the fan's pointed straight at them, and it's the other ones shoveling it into the fan, to them.
Lovely.
And
that is a great image. Thank you, Shawn.
So hopefully Scranton's here with maybe some insurance advice or coverage to help protect them or something like that, because they're in a bind.
Yeah, and unfortunately, I don't know that I have any good news there, especially after that image.
That's not good.
No, yeah, usually your CISO is going to be part of the. If you look deep into your policy, you may have something called a control group, and your CISO is part of that control group. It's usually your C-suite, your CISO, and these are the people that, if they have knowledge of an event, they're the ones that need to come forward and say, yes, I have. I'm talking about a security event. That yes, I have knowledge as of this day, and that's where the whole, that's where the claim process starts, et cetera. And so, once they have knowledge of something of an event happening, and you're in that control group, which CISOs usually are, that's where the process starts. I guess more back to that point, it's kind of CYA. It's sending. Are you sure you don't want to purchase CyberArk? Are you sure you don't want to implement PAM? That kind of thing. And usually I know that executives are, there's some trepidation about saying no for, security. And, CISOs are always in that bind, especially if they're part of if they're underneath an IT group, where IT might be seen as overhead, and, maybe access to budget is limited. Then it gets even more difficult, because maybe the resources aren't there.
Yeah. Um, okay. Well, that's
Good
on that
pressing.
light note. Maybe we switch over to for a minute. Just do you have any Shawn Scranton, do you have any good news from the insurance side of things?
I do.
Last time we talked, man, everything was like doubling, tripling. You know, it was going to be harder to get insurance. It was going to be more expensive. Has that gotten? Actually, let me start with the question that's really on my mind, and I'm sure a lot of people's as well. Is has the uh, has the additional requirements that cyber insurance has imposed, along with the rules around payouts and all that, has that raised the bar on security in general?
Yeah, I think it is. I think it has. Through 20 and 21 and even into 22, if you don't have MFA in place for remote access, for instance, you're not getting insurance.
Okay.
If you don't have EDR for your desktops, laptops, you're probably not getting insurance because of the ransomware issues. And so that control rigor is still there. I think insurance companies have learned that, good controls makes fewer claims. And so that's affected pricing. That's also affected more insurance companies coming into the market. And this is very much a supply demand. Here's a supply demand curves going on. Supply demand function where you have more competition in the market, then pricing usually goes down. But I don't want to, I may kind of burst your bubble here. Right now, pricing is currently flat, up 10%. But you have to take that into account where the price increases we saw, like, okay, we're tapering a little bit, but we're still up on top of this, what I see as kind of a high mountain, because we haven't seen much as far as declines. So it's kind of like a real world situation. Yeah, inflation was up, 8, 9%, and maybe it's going to start going down a little bit, but inflation was up, 8 and 9% over the past year, right? So
Good God.
so pricing is still high. I haven't seen many declines, but we are starting to see some flattening.
Are we seeing because for a while there we were seeing some very creative ways to say no, we're not paying for this. I keep coming back to Tuma. You and I talked about was it Zurich that once CrowdStrike said we think this is a nation state actor, the insurance went, that's war, we're out. Like, so are we seeing any more of that kind of stuff, or has the because the concern I've always had is you're buying insurance, you're like, boy, I hope this pays when I need it, right? The rules around when you can use it was just sort of murky. Has that standardized? Has that stabilized? Has it gotten more clear? No.
It's the war exclusion that you mentioned is actually it's fuzzy. We did have some action back in January over in Europe with Lloyd's of London, and other carriers they're just trying to find their way with this. We have seen a few carriers that have added systemic risk or systemic event exclusions. Very, very few, though, to where if you have, let's say, multiple cloud providers going down, we don't want to cover that. But fortunately, that's very few. Because of the supply and demand function, usually when there are exclusions like that, you may see other types of financial insurance vehicles come in to kind of fill those gaps. So there, I would say it's encouraging. I would say the underwriting rigor as far as what controls you have in place, that really hasn't changed much. They're kind of holding to their guns on that. They're saying, yeah, you need to have these controls in place. However, where we have seen some softening is, in 2021 or so, you couldn't buy more than 5 million from a carrier. Now you can, it's going back to where you can buy 10 million.
Okay.
We've also seen clients that they're now decreasing their deductibles, decreasing their retentions. So, maybe the cost is about the same, but you can actually have a lower deductible, which would be better, especially for those high frequency, low severity events. But you know, the other focus on metapixels and BIPA, as Shawn went through, you know, that focus is still there. And we're also seeing a lot of clients come to us, come to WTW as far as what is my optimal purchase price for insurance, and we have analytics that we run, and we tell them, hey, this is where we think you should be, because buying cyber insurance is very much, you know, it's rare that you see someone say, I want 57.34 million of cyber insurance. It's 25 million, or it's 50 million, or it's 75 million. They're very human. I'll put it as human-based numbers.
So,
hey, Raph, I want to
Yeah.
jump in on something with that active war issue, because I know it was it gets a lot of attention because everybody is worried that the carriers are going to look for an excuse to deny coverage. And the whole active war thing got a lot of attention over the last, as Shawn said, winter. And in my experience so far, it's been more of an academic discussion than it's been a real world discussion, because other than, the highlighted cases, the case that makes the news most often about it,
yeah.
I'm just not seeing claims get denied on that basis.
Okay.
We handle a good number of ransomware cases with insurance claims where they are threat actors that can be traced usually to Russia, but others, to other countries as well. And we're not seeing those claims get denied.
Okay.
In general, we're not seeing them even mention active war, even though we have this whole Russia-Ukraine conflict going on right now and all that. And so I know it's a fear. I know it's a talking point, and it certainly gets a lot of attention on the LinkedIn groups and everything else. I'm not seeing it. Now, the reason we may not be seeing it is because we're not seeing claims of $100 million or $70 million, right? It may be something where if your claim's for $1 million, we're not going to invoke it. Enough money, it's worth making that argument. I don't know the answer to that. I just don't want people to run from this and say, oh my God, the act of war, I'm not getting coverage because we're not going to get paid, because I'm not seeing that.
Yeah, it's very this. We've had many conversations like this, guys, where with you guys, Jeremiah was on many million years ago, and the whole hope was that because initially people got cyber insurance relatively easily, insurance got burned, they created some rules. Those rules forced customers to level up. That insurance leveled up as bad guys leveled up. And this was going to be one of those like stair steps up. And that's what I was hoping was going to happen, right? That's my hope, is that as insurance companies, Scranton, as insurance companies get better at understanding the risks their customer face and the likelihood of them putting out huge sums of money to solve some of these things, okay, maybe this raises all the boats, which was what I was hoping for.
I think it does. I mean, I think Shawn mentioned that earlier. I believe this is helping security because, whenever, well, a couple points. One, I work with a lot of small and mid-sized companies, and when we talk cyber due diligence and they're acquiring somebody, I do a lot of M&A due diligence work. And I tell them, look, if I only get one question to ask a target company before I acquire it, I want to know if they have cyber insurance. Because if they have cyber insurance in today's market, I know they're at a baseline as opposed to many, right? That's number one. Number two, I think we are seeing this educational standpoint by people like Shawn Scranton, who are going out on the broker side and telling their clients, if you want this coverage, this is what you have to do, and here is why. And so, I think we are seeing an education and a growth in the community and an improvement in security, we're seeing the threat actors resort to old tactics to find vulnerabilities. Now they're going back to the humans, social engineering, business email compromise. As we've seen some of our ransomware cases go down, we've seen our business email compromise, social engineering cases go up. And it is interesting to note we see more policy denials because of that than we see from anything else. And it's because policies are getting more nuanced in describing what's covered, what's not, and what controls must be in place from a social engineering standpoint before it even invokes coverage. So there's no coverage because they didn't comply with the terms of the policy. But what they didn't do is read their policy and see that before you're going to get coverage for this social engineering event, business email, or, wire transfer fraud, you have to have complied with not only sending the email, but also picking up the phone and calling to verify and documenting that process at the time. If you didn't do that, there is no coverage. There are policies that go into that kind of granular detail. And so we're seeing the insurance market respond by imposing, in a sense, like it did with seatbelts decades ago, of saying, if
Really?
we're not covering you if you don't do the things that are going to make you safer, we're just not going to cover you.
But that makes logical sense. I mean, like that
It does.
like that's where I kind of was hoping things were going to go, and it seems like that's the like saneness and rationality are persevering, which is a really good place for things to go. All right, we got a couple of minutes left in here, and I want to make sure that I covered kind of all the things. Hey, the thing people talked about forever, and some of us are still talking about it, the Move It breach, the Move It breaches. How's that rippling across? Like, is that setting any new precedents, any new standards, anything? What's going on there?
I'll tell you my perspective.
Yeah.
It's something I've been saying for years. You remember when we used to hear that nonsense of, instead of spending money on security, I'm just going to get the insurance, right?
Yep.
And people used to talk about that, and as though that's really a thing. One of the other things I've heard people saying for 15 years now is, I'm not worried about it because I hired someone else to do this, because we have this other provider doing this for us. So it's not my problem. And what I've been telling my clients and people who will listen to me, which aren't many, for years, is their breach is your breach.
Yeah.
Okay. Their breach is your breach when you entrust a vendor for something, right?
Yeah.
And now with Move It, we're seeing the ripple effects of their breach becomes your breach, and now you have to deal with the consequences. You're facing the litigation. You're going through the notification process a lot of times. So that leads into who pays for it, Shawn.
Yeah.
Your bad guys are going to go to where they can make money, and the easiest way they can make money. And if they find a vulnerability in some piece of software that is moving vast amounts of different types of data, absolutely, let's go after that. And that's I think that's Move It in a nutshell. I think it's becoming too difficult to or more difficult to do the business interruption because controls that were mandated by insurance. I mean, it's not all insurance that's doing that, but controls that were mandated by insurance, it's harder to get business interruption ransomware. And so let's go to the data breach side. And so I personally think that's why we're seeing this move towards more data breach. And if you can get a vendor, whether it's SolarWinds, whether it's Progress Software with Move It, then let's do that. It's easier.
Well, it's interesting, right? Because there is so much with a lot of stuff going to SaaS, right? it breaking into one vendor,
Yes.
a high profile CRM provider, for example, suddenly causes a massive ripple effect to everybody. There are thousands of customers, hundreds of thousands of customers. And so it's like that bad bank robbers quote, right? Why do you rob banks? That's where the money is.
Yep.
Why do you hack?
Yep.
So this is the argument that was made when you guys remember when Apple Card was people were starting to talk about Apple Card, and they're like, oh, this is gonna completely eliminate the risk from the end user or from the end businesses, and it's gonna centralize it all. But then those of us that were rationally looking at this kept going, yeah. But now you're not hacking, a mom and pop shop for 50 cards. You're breaking into the central place. Granted, a little more risk, but a lot more reward, and then it impacts everybody.
And you're not going to deter hackers by saying it's harder to do this, right? You're
Yeah,
gonna
that's like game on.
a lot of them
Exactly.
just to see if I can go do this now, right? And one of the things that I am seeing, because we have several of these cases for companies that are impacted down the supply chain, from this, I'm seeing a great deal of cooperation between the upstream companies and those below them in the supply chain. I'm seeing a great deal of cooperation from the insurance carriers of trying to make it right as it needs to be. And it's good. It's good to see that. But at some point, it's all going to come crashing down. But the other thing is, when we talk about insurance, it's important for companies to understand you're not just protecting yourself from attacks on your own organization. You're getting coverage to protect yourself from when those you rely on have attacks on them, and they don't have enough insurance money to go around to cover everybody. You're going to be left out in the cold there. You need your own insurance that's going to step in and help make this right from your standpoint. And then they can go fight with each other behind the scenes and work out who's paying for what at the end of the day through subrogation. You need money there today to make your company whole again and do what needs to be done.
So translated into insurance, you will be asked on your underwriting calls or your application, what do you do for third party or vendor management? And I know from my previous experience, third party vendor management is extremely difficult. It's very hard to do. It's probably one of the harder things to do. And I knew that as I looked at a potential insured when I was an underwriter, if they had great third party vendor management controls, usually everything else was in place. And I'm like, okay, they're going to be a good risk. I'm going to write them.
And I have a point I got to get in here when we're talking about third parties and vendors and all this. One of the biggest problems I see right now is everybody's paying attention to the new privacy laws and the cyber requirements and the breach notification laws and all this stuff. Nobody's reading their contracts. Okay, your contract is the law between the parties. It's every bit as much law as this new privacy regulation or law that comes out. When I get called by companies and they say, hey, we've just had this incident, do we have a duty under the breach laws? Maybe not, but what do your contracts say? And you know what they tell me? They tell me, well, I don't know. How are we supposed to know that? We have too many contracts.
Oh, boy.
You have to know what your contracts say, because what may be defined as a breach or an event or an incident, or you must give notice within under one contract may be defined very, very differently under another. You have to know what your contracts say in this regard, or you're going to be in trouble down the road.
All right. Well, so let's see. Let's recap this episode. Things have gotten worse. Things have gotten better, but overall, I think we're headed in the right direction, as long as that direction isn't sudden death. So that's about where our conversations usually go, gentlemen. Hey, parting thoughts. And I'll what's the because we're gonna have to do this more than every 12 months. Maybe we'll do this every quarter or something, guys. Where's this going? Like, what do you give me a forecast? Give me a weather forecast, Scranton. I'll let you start.
Yeah, I think we're going to, as the control rigor increases, as insurance companies demand that rigor either increases, you can't stay the same. If you go into an underwriting meeting, say, yeah, we didn't really do much this year. We just kept things, status quo. No, they want to see you moving forward, keeping up with threats. I think we're going to see fewer on the business interruption side. We're going to see more on the data breach side. And as Tuma pointed out, business email compromise, it's going to be more geared towards human vulnerabilities rather than technological.
Tuma?
Yeah. So, I agree with that 100%. Especially on the methods of attack, as companies are getting more sophisticated on their technological defenses, they're forgetting about some of the easier, not really easier, but less sophisticated means of like calling your employees and getting them to go to a website, and do something. It's from a legal and a regulatory standpoint, look, this is victim shaming at its best. We are not going to get away from that. Politicians, regulators, they need an easy target to go show we're doing something, we're trying, we're doing something, right? And the easy target are the companies that are victims of this criminal actions.
Yeah.
And so it's not going to get any better for the companies. One of my favorite sayings is there's no one coming to help. You have to take care of yourself.
Yeah.
Companies, you cannot over prepare in this environment because the opportunity, the reward is there for the bad guys to come after you. Once they come after you, you are then transmorgified from being the victim into the wrongdoer. And regulators are going to come after you. Plaintiffs' lawyers are going to come after you. You're going to get blamed for this. So really I wish there was a way around it. There's not. You have to protect yourself to the best of your ability.
Well, on that sunny note, thanks, Tuma. We're gonna call this one done, gentlemen. Let's do this quarterly if we can, if schedules permit. Maybe you even get to schedule the quarter ahead of time. But folks, thanks for listening. Hopefully you got to watch some of the video. I have no idea what's going on with James's connection, but I'm pretty sure he's still texting me back. So Florida's still there, but maybe he got swallowed by a slightly larger black hole. But again, get a chance to watch the video. Check out the group on the page on LinkedIn to see us there. I post some content there. I do shorts on YouTube as well, just kind of recap things we talk about weekly. Give those a look. The videos are on YouTube. The videos are on LinkedIn sometimes. And for the Down to Security Rabbit Hole podcast, I thank you guys for listening. We'll catch you again. Subscribe, like, and all the other things people are supposed to.